Hi, welcome back to Joe Blogs. This video is the next in a series looking at the financial implications of Russia's invasion of Ukraine on the global economy. And in today's episode, we're going to have a look at the impact of the European bans on the purchase of crude oil and refined products, and also the price caps that were brought in on the 5th of December and the 5th of February. So we'll start off by looking at the overall impact on Russia's revenues from Europe and the rest of the world for all of their products. We'll then go on to have a detailed look at the revenue from the different types of products, which countries are now the largest buyers of Russian fossil fuels, and then finally today I'll wrap up with my summary as to what I think the impact of these bans and price caps have been so far for Russia, what's likely to happen over the course of the next 3 to 6 months, and what the impact of this will be on the Russian economy. So before we get started on all of that, if I can ask you for a thumbs up at some point during this video if you're enjoying the content, please subscribe if you haven't done so already. Don't forget, I always include chapters, so if you don't have time to watch everything, you can pick and choose what you'd like to see. And if you'd like to support the channel, please have a look below, where you'll find links to YouTube Super Thanks and membership, as well as Buy Me a Coffee and Patreon. And as always, I'd like to say thank you so much to everyone that has supported the channel. And for anybody that's left a comment with regards to pop filters, I am actually using a pop filter today, so hopefully you can notice the difference. Before we go on to talk about the impact on Russia's revenues, I wanted to cover off a bit more detail on the price cap because I'm conscious of the fact that we haven't looked at the refined oil price cap in any detail. As I'm sure you'll be aware by now, on the 5th of December, the European Union brought in an outright ban on the purchase of all crude oil that was transported from Russia over the sea. The European Union is comprised of 27 different countries, and the vast majority of these countries are now banned from buying all of these products. There are actually a few exemptions, such as the Czech Republic and Hungary, who are landlocked and are having difficulty finding alternative suppliers. But most of the oil that those countries are buying are being supplied by pipelines. At the same time as the European ban on crude products was brought in, a price cap was introduced by the West on the sale of all Russian oil, and this cap was set at $60 per barrel. Now, in terms of the details of that cap, there was actually a transition period of 45 days that was introduced, which permitted the delivery of all oil orders that were placed prior to the 5th of December. And that exemption gave all of the shipping companies until the 19th of January to complete all of those deliveries. Now, in order to take account of the fact that the price of oil moves on a daily basis, and to ensure that the price of $60 remains relevant, the price cap that's been applied on Russian oil is reviewed every 2 months to respond to developments in the market. And if required, the price cap will be adjusted to a level at least 5% below the market average price for Russian oil. So the price cap for crude oil is relatively simple. It's currently set at $60 per barrel and will be adjusted as and when the price of crude oil moves to a level that $60 is no longer appropriate. Now, as we discussed at the start of the video, a second price cap was introduced on the 5th of February relating to refined oil products. Now, as you're probably aware, refined oil relates to all of the products that actually are used in the market. Crude oil in its natural form isn't something that can be used as a fuel. It has to go through a refinery process so that you can produce the finished products such as gasoline and diesel. And this chart gives you an example of the products that can be produced from crude oil once they've been through the refinery process. And interesting, the volume of refined products that are produced from a barrel of oil are actually greater than the volume of the initial crude oil, due to an effect known as the processing game, as a result of processed petroleum products having a lower specific gravity than the initial crude oil. Now, in terms of giving you a volume reference point, a barrel of oil contains around 45 gallons of crude oil. So out of those 45 gallons of crude oil, you can produce around 19 gallons of gasoline, 10 gallons of diesel, 4 gallons of kerosene jet fuel, 5 gallons of coke, and then a whole load of other products that are used in a variety of industrial processes. And the reason I wanted to show you this chart is really to put into perspective the difficulty of setting a price cap for refined products, because all of these products trade at completely different prices. So whereas we were talking previously about crude oil, which is a single commodity and is quite easy to set a price cap for, when you're talking about all of these different products, it's much more complicated. And this issue has been something that's been taxing all of the authorities when trying to set the price cap for the refined products. And the way that this has now been addressed is that 2 different price caps have been introduced. The first price cap relates to products that trade at a discount to crude oil. So these are a lot of the residual products that are used in industrial processes. They tend to be the heavier types of fuel that are less efficient and therefore have a lower value. and the price cap that's been set for those products is $45 per barrel. Now, the second price cap relates to products that trade at a premium to crude. So these are the most valuable products such as gasoline, diesel, and jet fuel. And the price cap for those products has been set at $100 per barrel. Now, in terms of the transition period for these price caps, it's been set at 55 days, which will enable the delivery of all orders placed before the 5th of February to be completed by the 1st of April 2023. And these price caps will operate in exactly the same way as the price cap for crude oil and will be reviewed against the market price every 2 months. So the price cap for crude oil products has now been in place for over 3 months, and the refined product cap has been in place for over 1 month. So let's have a look at what the impact has been on Russia's revenues. Now, before we go on any further today, I want to talk to you about today's sponsor, Atlas VPN, and to let you know about their amazing 3-year deal whereby you can get full coverage for only $1.83 per month, including an additional 3 months extra and a no-risk 30-day money-back guarantee. If you use the internet without any form of protection, you leave yourself exposed to tracking, hacking, and advertising. Using Atlas VPN protects you from all of these. Atlas VPN provides you with comprehensive security and is used by more than 6 million people worldwide. So it's fantastic news that it will protect you from hacking and tracking and data breaches. But what's also great news is that it can save you money and open up a whole new world of entertainment, because it allows you to change your location, which gives you the opportunity to get better deals and to access content that may not be available in your region. Atlas VPN is available to use on unlimited devices for one subscription, and Atlas VPN is currently offering an amazing 3-year deal whereby you can get full coverage for only $1.83 per month, including an additional 3 months extra and a no-risk 30-day money-back guarantee. So to purchase this exclusive Joe Blogs offer, please click in the description below. This chart shows Russia's revenues from the sale of fossil fuels dating back to September 2021. And there's 3 dotted lines on this chart. The first dotted line is on the 24th of February, which was the date that the invasion of Ukraine started. The second dotted line is the 5th of December, which is the date that the European Union banned the purchase of all crude oil products delivered over the sea, and the price cap of $60 was introduced. And the third line is the 5th of February, which is the date that the European Union introduced its ban on refined products, and the price caps of $45 for products trading below crude prices and $100 for products that trade above crude prices were introduced for refined oil products. Now, the scale on the left-hand side of this chart is measured in millions of euros per day. However, it is easier to talk about dollars because I think more people globally understand what a dollar is worth rather than a euro. In the currency markets at the moment, €1 is trading for around $1.07. So they're very similar in terms of value. The euro is worth slightly more. So I'll refer to all figures for the rest of this video in dollars. And the colour coding on the bar charts relate to the different types of fuel. Pipeline gas is shown in dark red at the bottom. Oil products are shown in lighter red. Liquefied natural gas is shown in orange. Crude oil is shown in purple. And coal is shown in black. And what this chart shows is that immediately following the invasion of Ukraine, the revenue that Russia was earning from the European Union actually hit a peak in March 2022 of around $700 million per day. And you can see at that time that the largest single category in terms of the type of fossil fuel was pipeline gas. Now, this was because there was a huge increase in the price of pipeline gas. Europe is being provided with this gas by pipelines directly from Russia, and as the price went up, so did Russia's revenue per day. But what you can see from this chart is that over the last 12 months, there has been a steady and continued reduction in the amount of revenue that Russia has been earning from the European Union. And I think it's really interesting to look at what's happened with the different categories of fuel. If we start with pipeline gas, you can see that there's almost a linear reduction month on month as various countries started to either voluntarily stop buying gas or had their supplies cut by Russia. And the level of pipeline gas in February is now at its lowest point at any time since September 2021. If we now look at crude oil, which is represented by the purple section towards the top of the chart, you can see that in the first 4 or 5 months, there wasn't actually a huge reduction in the revenues that Russia was earning. And that was partly because prices of crude oil went up significantly. And so any volume reductions were being offset by an increase in the price. However, in September, October and November, we did start to see a reduction in those revenues, partly driven by the fall in the market price and partly driven by the reduction in volumes. But if we look at what's happened from December the 5th onwards, which is when the European Union brought in its outright ban and the price cap was introduced, you can see that there has been a dramatic reduction in the amount of revenue that Russia is earning from the sale of crude oil to the European Union. And the revenue in 2023 is now at its lowest point that it's ever been. And if we now look at refined oil products, which is shown in the light red section across the middle of this chart, you can see that in the first 5 months following the invasion, the amount of revenue that Russia was receiving remained relatively stable. And again, this was partly driven by an increase in prices and a slight reduction in volumes. In August, September and October, we did start to see a slight reduction. However, in November and December, there was actually an increase in the revenues that Russia was receiving. And this was because a lot of the European countries were aware that the ban was coming in and Russian products were trading at a discount in the market. So they represented an attractive buying opportunity. So a number of countries loaded up and stockpiled on refined products. However, if we look at what's happened to Russia's revenues from the European Union following the ban on the 5th of February, it's now virtually disappeared from this graph. So if we now take a step back and look at the overall picture here, in March 2022, Russia was receiving around $700 million per day from the European Union, which on an annualized basis would equate to around $250 billion per year. In February 2023, Russia's revenues from the European Union have dropped to around $50 million per day. So on an annualized basis, that equates to around $18 billion per year. So comparing Russia's revenues from the European Union from March 22 to where they are today, it represents lost revenue on an annualized basis of over $230 billion. This chart shows Russia's total revenues from the sale of fossil fuels globally dating back to September 2021. And the colour coding here is exactly the same as it was on the previous graph. We've got pipeline gas sales at the bottom, followed by refined oil products, liquefied natural gas, crude oil and coal in black at the top. And as you can see from this chart, Russia's revenue from the sale of fossil fuels peaked in March 2022 at more than $1.1 billion per day. For the next 3 months, Russia's revenues remained high, above $900 million per day, as a result of the fact that the price of fuels had spiked globally due to their invasion of Ukraine. However, from July 22 onwards, Russia has seen a steady and gradual reduction in its revenues, which is partly driven by the fall in market prices as a result of the global slowdown, and partly because of all of the bans and price caps that have been introduced against Russian fossil fuels. And in February 2023, the total revenue that Russia earned from the sale of all of its fossil fuels was around $600 million. So this represents a fall of around 50% from the peak level back in March 2022. And if we now look at the breakdown of where Russia has lost its sales, you can see that it's lost revenue from every single one of these categories. Pipeline gas sales, shown by the dark red section at the bottom, have fallen dramatically. And this isn't surprising because the vast majority of all Russia's gas sales were being made to Europe via the pipelines. However, most countries in Europe are no longer buying that Russian gas. The next biggest category in terms of lost revenues is crude oil, and Russia has seen a reduction of around 40% in all of its revenues as a result of the sanctions that have been applied against Russian oil. If we now look at refined products, which is shown by the red section in the middle of the chart, you can see that revenue from refined products have actually held up quite well. However, there was a notable reduction in February following the introduction of the ban by the European Union and the price caps against refined products. And as the transition period works its way through and the European Union stops taking delivery of all of the refined products that were ordered before the 5th of February, it's likely that we will see the same trend happening with refined products as we can see with crude products here, and there will be a continued reduction in revenues. And if you follow the channel, you'll know that the problem that Russia is facing is that refined products are far less attractive to countries like India and China because they have their own refineries. So they would rather buy crude oil, which is cheaper and easier to take in large volumes, than purchasing the finished products, which are more expensive and have to come in individual deliveries. So Russia's really struggling to find alternative markets from all of the lost sales for Europe. This chart shows Russia's daily revenue that it's earning from exporting 5 different types of fossil fuel. And the 5 different types of fossil fuel shown here are crude oil, refined oil products, coal, pipeline gas, and liquefied natural gas. And this chart dates back to January 2022, so around 2 months before Russia's invasion of Ukraine started. And once again, we've got the 3 dotted lines shown here. The first one is the 24th of February when the invasion commenced. The second one is the 5th of December, and the third one is the 5th of February. Now, if we start off by looking at the position in January 2022, you can see that at that time, Russia was earning around $250 million per day from the sale of crude oil, around $210 million per day from the sale of pipeline gas, $120 million per day from the sale of refined oil products, and then somewhere in the region of $30 million per day from the sale of coal and the sale of liquefied natural gas. So if we start off by looking at the impact on crude oil, you can see that in the build-up and following the invasion, there was a marked increase in Russia's revenues from the sale of crude oil, and this was predominantly driven by the large increase in oil prices in the market, which offsets some of the reduction in volumes. However, since that point, there's been a steady reduction in the amount of revenue that Russia has been earning, and the current level of income is now around $300 million per day. So above where it was in January 2022, but significantly below the highs of the summer of 22. If we now look at what's happened to the revenue from pipeline gas, you can see that immediately following the invasion, the daily revenue that Russia was earning increased to around $325 million per day, as a result of the large spike in the price of pipeline gas at that point. However, since that high in April, Russia has seen a marked reduction in revenue. And revenue from the sale of pipeline gas is now down to around $60 million per day. So that represents a fall of around $150 million per day compared to where Russia was at the start of 2022. If we now look at refined oil products, Russia's revenues increased from around $125 million per day to over $200 million per day immediately following the invasion, driven by the increase in market prices. However, since that point, Russia has seen a steady reduction in the amount of revenue that it's earning from these products. And the level of revenue is now down to around $100 million per day, so below where it was at the start of January 22. But the impact of the ban and the price caps that were brought in on the 5th of February are not really showing in this chart. As we roll forward over the course of the next 3 to 6 months, it's likely that the revenue from these products will also fall significantly because, as we discussed earlier in the video, it's difficult for Russia to be able to find new markets because China and India are not interested in buying large volumes of refined products from Russia. They want to do it themselves. If we now look at the revenues from coal, you can see that over the course of the last 12 months or so, there has been a steady increase in Russia's revenues. And the reason for this is that the increases that we've seen in oil and gas prices over the course of the last 12 months have led to an increase in demand for coal. Some countries have actually reverted back to coal-fired power stations for creating electricity. And so as demand for coal has increased, so has the price, and that's led to an increase in Russia's revenue from coal exports, which is now at around $70 million per day. Now, what's happened over the course of the last 12 months with regards to Russia's revenue from liquefied natural gas sales is really interesting. At the start of January 2022, Russia was earning around $30 million per day. And over the course of the last 12 months, the demand for liquefied natural gas globally has increased dramatically. And this has been driven predominantly by all of the European countries having to get off Russian pipeline gas and bring in liquefied natural gas facilities. So we've got a lot of countries who have moved into liquefied natural gas as a direct result of Russia's invasion of Ukraine. And that's caused liquefied natural gas prices to increase globally. So in terms of that dynamic, you would have expected Russia's revenues from the sale of liquefied natural gas to have increased dramatically over the course of the last 12 months. But as you can see, that hasn't happened. And in February 2023, Russia's revenue from liquefied natural gas was only around $45 million per day. And the reason that Russia hasn't been able to capitalize on the increased demand for liquefied natural gas is that it doesn't have the facilities to be able to convert the natural gas that it's been providing to Europe into liquefied natural gas. You need to set up these huge plants to actually be able to liquefy gas. And historically, Russia has partnered with international oil and gas majors such as Shell to design, build and pay for these facilities. But of course, since the invasion of Ukraine started, a lot of Western companies exited from Russia, and so Russia has lost its trading partners. And because it's also lost all of its markets for natural gas to be supplied in its natural form, it now needs to build a huge amount of these LNG facilities. But without that external investment, it's struggling to be able to put that new capacity in place. So Russia hasn't been able to convert all of the gas that it was previously selling to Europe into LNG because it just doesn't have have the facilities to do it. So the overall summary of this chart is that Russia has seen a significant reduction in the amount of revenue that it's earning from its two biggest fossil fuels. Revenue from crude oil is down by around 40% compared with the peak of 2022, and revenue from the sale of pipeline gas is down by more than 60% compared with the peak in April 22. Russia has also experienced a fall in revenues from the sale of its third most important fossil fuel, refined oil products, over the course of the last 12 months. And the only products where Russia has seen an increase in revenues are its two smallest contributors, coal and liquefied natural gas. However, those increases have been hugely offset by the falls in revenue from the other three products. And when you take a step back and look at this graph, you can see that the vast majority of the income recorded here was earned before the price caps and the bans from the European Union were put into place. They were introduced quite late in this chart. And if we were to roll forward another 6 or 12 months, it's likely that the impact of those bans and caps will further reduce the amount of revenue that Russia's earning from crude oil, refined oil, and pipeline gas. This table shows which countries have been buying Russian fossil fuels since the start of 2023. And it's broken down into 4 categories. In the bottom right-hand corner, we've got crude oil. In the top right-hand corner, we've got refined oil products. In the bottom left-hand corner, we've got liquefied natural gas. And in the top left-hand corner, we've got coal. So let's start with Russia's biggest single export, crude oil. So as you can see, the single largest buyer of Russian crude oil in 2023 is China, having purchased around $6 billion worth of crude. The second biggest buyer is India, having purchased over $3 billion worth of crude. The values on this chart then reduce significantly to around $300 million. And third on the list is Turkey, followed by Malaysia, Egypt, Bulgaria, Singapore, the Marshall Islands, the UAE, Saudi Arabia, Tunisia, Cuba, Senegal, Taiwan, and South Korea. If we now look at the chart for refined oil products, you can see firstly that the scale is completely different, and secondly the order of the countries is also very different. At the top of this list is Turkey, which has purchased around $1 billion worth of refined oil products, followed by the UAE, which has purchased around $300 million worth, Morocco, the United States, which I think is an interesting inclusion, China, which has purchased around $150 million worth of refined products, Singapore, Tunisia, India, which has purchased around $100 million worth, Brazil, Bulgaria, Egypt, Algeria, Indonesia, Georgia, and Nigeria. If we now move on to coal, once again, you can see the scale has reduced further, and the number one purchaser of Russian coal was China, having purchased around $900 million worth, followed by Turkey, who purchased around $650 million worth, India, who came in at around $600 million, South Korea, Japan, Taiwan, and Morocco. And then finally, liquefied natural gas, and again we've seen a reduction in the scale here. The number one purchaser of LNG from Russia was Japan, who purchased just over $500 million worth, followed by Belgium, Spain, China, South Korea, Netherlands, Portugal, Sweden, Finland, and Norway. Now, you may be surprised to see a number of European countries on this list. However, there isn't actually a formal ban in place with regards to liquefied natural gas, and these countries are having to buy whatever they can get in the market. So going forward, it's likely that most of these countries from Europe will not continue to buy Russian LNG if they can find alternative supplies. And this chart shows the largest importers of Russian fossil fuels since the ban on refined products was brought in on the 5th of February. And the colour coding on this chart is similar to what we looked at previously. We've got pipeline gas in dark red, we've got crude oil in purple, refined oil products are shown in red, and coal is shown in black. So you can see that since the ban was brought in, Russia's single largest customer is China, and the vast majority of the revenue that Russia is receiving from China relates to crude oil sales. And it's interesting to note that even though this chart records all of the sales of refined products since the ban was brought in by Europe, there hasn't been a massive increase in the sale of refined products because, as we discussed earlier in the video, China is not interested in paying high prices for refined products when it's perfectly capable of being able to refine crude oil itself. Interestingly, Russia's second biggest customer for the sale of fossil fuels since the 5th of February is the European Union. Now, if we look at the breakdown of that revenue, you can see that around 25% came from the purchase of pipeline gas. And these are the countries that are struggling to be able to get replacement facilities in place. So it's likely that that revenue will continue for the foreseeable future. Purchase of refined oil products represents around 30% of the total revenue. Now, instinctively, you may think that there shouldn't be any sales because this table shows the position after the ban was brought in. But as we discussed previously, there's a transition period where all of the countries who made orders before the 5th of February can still take delivery. So this really relates to all of those sales. If we were to roll this graph forward 3 or 6 months, the level of sales for refined products would stay static because this wouldn't be increasing. All of these sales have now completely stopped. The next largest category of sales to the European Union is liquefied natural gas, and as we just saw on the country breakdown, there are a number of European countries that have been buying Russian LNG, and that's predominantly because there isn't enough LNG in the market at the moment. The capacity can't meet the demand, so countries are having to buy Russian liquefied natural gas. As we go forward, it's likely that producers will try to produce more LNG. We're seeing a lot of imports coming from the USA. That will continue over the course of the next 5 to 10 years because a lot of countries in Europe are moving away from the pipeline gas and onto LNG. And the final category here is crude oil, and this relates predominantly to the countries that have been given an exemption who are struggling to be able to find economically viable alternative suppliers to the Russian crude oil that was provided by pipelines. Russia's next biggest customer is India, and you can see that the vast majority of the revenue from India relates to crude oil, although there are some refined products and some coal. Turkey is Russia's 4th biggest customer, and interestingly, their largest purchase relates to refined products. Turkey doesn't have as many refineries as other countries around the world, and alongside the refined products, they're also buying large amounts of pipeline gas and coal from Russia. Now, the rest of the countries on this list are significantly smaller than the top 4, and they are Japan, Singapore, Egypt, Malaysia, UAE, South Korea, Taiwan, Senegal, Saudi Arabia, Tunisia, and Brazil. Now, once again, if we take a step back and look at this chart, going forward, the European Union sales will continue to reduce. So Russia will need to offset those lost sales with additional sales to other countries. And the 3 countries that it's really focusing in on are China, India, and Turkey. So the success of the Russian economy is really dependent on those 3 countries. So what's the summary and conclusion today? Well, I wanted to post this video really to provide you with an update on what's happening as a direct result of the European Union bans and the price caps that were brought in over the course of the last few months. We're starting to see the impact feeding through into the actual results, particularly for crude oil, as those bans and that price cap have been in place for more than 3 months now. And what we have seen is a dramatic reduction in Russia's revenues. As we saw from the data earlier, compared with this time last year, revenues are down by around 50%. So that is going to have a huge impact on the Russian economy. Russia has lost more than $500 million worth of revenue per day, which on an annualized basis equates to more than $180 billion. That is a significant reduction in cash. Now, the European Union and the West have only really started ramping up the sanctions since they introduced the bans and the price caps, so this is a relatively recent event. Russia is already suffering from a dramatic reduction in its revenues, but it's likely that over the course of the next 3 to 6 months, we will see a further impact of those price caps and bans. And one of the biggest concerns from Russia's perspective right now relates to refined oil products. Oil refinery is big business in Russia. Russia has 32 oil refineries all across the country, and it's processing around 5 million barrels of crude oil every single day. And the end products that Russia is producing are high margin. Those sales contribute more to the Russian economy than the sale of crude oil. And the problem that Russia is facing is that India and China are not interested in buying those refined products because firstly, they're priced at a premium level, and secondly, India and China have their own refinery industries. They can take the crude, refine it, and then either use those products in their home markets or sell the finished products into the international markets. So buying crude gives you more options and you can actually make a profit from doing it. There is absolutely no potential for making a profit from buying finished products, and so India and China just aren't interested. Russia's biggest single market for selling refined products into was the European Union, and if it can't find a replacement for those sales, then that means that Russia will have to stop refining all of that crude oil. So that's going to have an impact on the economy for 2 reasons. Firstly, there'll be a reduction in profit because these are the most valuable sales that Russia's achieving. And secondly, there'll be a reduction in terms of the loss of employment across Russia if they have to close some of their refineries because they don't have sufficient capacity to put through them. And with an oil refinery, you get to a point point where if it doesn't have sufficient amounts of volume coming through it, then you will have to just shut it down because it becomes totally cost inefficient to keep running it. And if Russia does have to reduce the volume of oil that it's converting from crude into refined products, that means that it's going to have even more crude oil that it needs to sell into the international markets. And so there's a further risk from Russia's perspective that it will have to offer even bigger discounts to keep those volumes flowing. Now, as we've discussed before, the biggest risk overall here from Russia's perspective is that they have to keep cutting back on production, because if they can't sell the oil, they have to stop drawing it out of the ground because they don't have anywhere to store it. And if they do have to cut back on production or stem the flows, then that could cause them major problems in the future, because when they want to reopen those flows, they may find that they've got issues with regards to clogging of oil underground, and there is a possibility that Russia could encounter catastrophic failure of some of its drilling facilities. So the overall summary of today's video is that the sanctions have had a major impact on Russia's revenues over the course of the last 12 months. And we're now starting to see the direct impact of the EU bans and the price caps that were brought in December and February. But over the course of the next 3 to 6 months, it's likely that there will be further impact on Russia's revenues because of those new sanctions. And that means that the outlook from Russia's perspective is highly negative over the course of the next 6 months or so. And that's going to have a further impact on the Russian economy, which posted a loss of $48 billion for 2022 and $25 billion in the month of January. So Russia is currently having to fund all of these losses from its reserves, and if revenue continues to fall, it means it will need to draw on those reserves even further. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up, and thank you for watching this video all the way through to the end.